In this video, we are going to further extend our discussion on goods. In the first video, we learnt about the final goods and the intermediate goods. Here we are going to discuss the two more ways of classifying goods. The final goods and the intermediate goods, which we discussed in the previous video. Now, the final goods can be both consumption goods as well as capital goods. Consumption goods are those goods which are used by the households, and the capital goods refer to those goods used by the firms. Since we learnt in a closed economy there are two partners, the firms and the households. Now let's discuss about the consumption goods. The consumption goods are also called as consumer goods because these goods are used by the households for consumption. Now, goods that are directly used by consumers for satisfying wants are called as consumption goods or consumer goods. Now, these consumption goods can be consumer durables or consumer non-durables. Consumer durables are goods like TV sets, automobiles, refrigerator, car, scooter, washing machine, which have a time span or say a life for some years. Then consumer non-durables are those which do not have a long lifespan, maybe a year or two. For example, food. Food is for immediate consumption, or certain food grains which can be stored for a small period of time. Clothing and services, the recreation part, that are consumed when purchased. So this part of it, the recreation part, which comes under the services, is that consumer non-durable which is consumed immediately. For example, you go to a park, you pay a small amount of fee to enter the park, and that activity is for that period of time only. Similarly, you go to a theatre for watching a program, that is also consumed at that very point of time. So these are called as consumer non-durables. Then the third one that we are going to discuss is the services, which is a non-material goods which directly satisfy human wants. For example, the services of a doctor, the services of a lawyer or a domestic help are immediately consumed. These are non-material goods, hence called as services. And then we have the capital goods. Capital goods form a part of capital. That means those goods which are for the use of the firms. The investment that is made by a firm will help in further production of goods. Such goods are called as capital goods. The capital goods are those goods which are not immediately consumed, instead are made use of in further production of goods. These goods undergo wear and tear. For example, a machinery that is bought by a firm in order to produce goods undergoes wear and tear over a period of time. The stock of capital is preserved, maintained, and renewed partially or wholly. The machinery that is bought by the firm undergoes wear and tear, and also the machinery is used to produce goods. Now, the additional production is stored for further use or future use. Then the machinery of the capital has to be preserved for a long period of time. It requires some maintenance, okay, or renewal. Therefore, capital goods are also called as investment goods because the firm makes an investment in procuring these capital goods. They are durable use producer goods because these capital goods, that is machinery, they have a time span or span of life. For example, 5 to 10 years long span of life. During this period, these capital goods undergo wear and tear, or some repair, or some maintenance. The examples of capital goods are machines, tools, equipments, etc., which form the asset for the firm. Now, the same good, that means a capital good or a consumer good, can be the same. For example, a car that is bought by a household will be a consumption good, whereas if it is bought by a firm for business purposes, it will be called the capital good. Similarly, the other example would be sewing machine. A sewing machine that is bought by a household will be a consumption good, whereas that bought by a firm, or let us say a tailor, becomes the capital good. Capital goods are fixed assets of producers. The use of these fixed assets leads to wear and tear, that is called as depreciation. That is, what is depreciation? It is a loss of value of fixed assets on repeated use. Since machinery is used repeatedly over and over again to produce goods, it undergoes wear and tear. The moment it undergoes wear and tear, there is loss of the value of the asset, and that is called as depreciation. Now, with reference to a particular point of time, let us take an example of a building or machinery which stays for a long period of time. Only additions or deletions can be made. This is called as stock. This is called as stock. The examples of stock are capital, wealth, population, inventory, balance in bank account. So how do you deal with this? We say that at a particular point of time, what was the population of a country? Suppose I say on 31st of December 2019, the population of India was this. Or let us say when the census is conducted, the population of the country was this much. Or let us say by 31st of January 2020, what was your bank balance? So this we talk with reference to a particular point of time, and that is called as stock. So to the stock, an addition can be made or deletion can be made. If you talk about the bank account, which we understand better, you can add some money to your bank account, or you can withdraw a part of the stock that you already have in your bank account. Okay, so that is called as stock. Now, the variable that is measured over a period of time, let us say a year, a month, week, etc., then that will be called as flow. That means to the existing stock, whatever is added or deleted would be referred to as flow. The examples include the annual income, output, profit and loss, export or import, savings, change in inventory, value added, and so on. Okay, one of the beautiful examples that is given in the NCERT book to learn stocks and flow is that of a water tank. Suppose a tank is being filled with water coming from a tap. The amount of water which is flowing into the tank from the tap per minute is called as flow. The amount of water which flows into the tank from the tap is called as flow. But how much water there is in the tank at a particular point of time, that would be stock. What is already existing in the tank would be stock. Now what we are adding would be flow. Now something which increases the stock of capital, or let us say a process of capital formation, is called as investment. So define investment. Investment is a process of capital formation, that which would increase the stock of capital. Now more the capital stock or greater the capital stock would imply a greater capacity to produce more number of goods. So investment is done on fixed assets. This investment on fixed assets is also called as fixed investment. This investment can be on inventory also. What is inventory? Holding stock of finished goods or raw materials or semi-finished goods. This is called as inventory investment. Why should one have finished goods or raw materials under stock? This would ensure continuous supply of goods into the market. There are certain conditions where recession can take place, or where the stock wouldn't move, or there is shortage of the stock, in that case, the stock of the finished goods or raw materials or semi-finished goods would be handy. Now, who would go to the market to get these raw materials every now and then? So, having a stock of raw materials is always advantageous so that there is no break in the production of goods. Now, the expenditure that is made on fixed assets and the expenditure made on the inventory stock together during an accounting year gives us the gross investment. So, the gross investment is the sum of the expenditure made on fixed assets and the expenditure made on the inventory stock. Now, we learned that during the production process, the machines or the fixed assets undergo depreciation. So, how do we define depreciation? It is the loss of value of fixed assets. Loss of value in terms of wear and tear or repair or maintenance of the fixed assets. So, the gross investment includes depreciation. The gross investment includes depreciation. And the difference between the gross investment and the depreciation gives us the net investment. Gross investment and depreciation. The difference between these two gives us the net investment. This net investment makes net addition to the stock of capital. Net investment makes net addition to the stock of the capital. Because the gross investment includes depreciation and depreciation is the loss of value, the net investment would mean that an additional stock has been added to the capital. To further with the depreciation we learnt is a loss of value due to normal wear and tear or an accidental damage or expected obsolescence. Loss of value is also called as consumption of fixed capital. So, depreciation, in other words, is consumption of fixed capital. So, this consumption of fixed capital is wear and tear, accidental damage. This obsolescence comes from the word obsolete. Obsolete meaning outdated. When new technology comes in, the old technology becomes obsolete or outdated. Now, when it becomes obsolete or outdated, the production capacity of a firm goes down. So, it is always required to have a depreciation reserve fund. Now, the fund required to replace fixed assets would be called as depreciation reserve fund. This depreciation reserve fund is very, very important because, see, depreciation reserve fund means a fund required to replace the worn out fixed assets. So, it fulfills the need for replacement investment. The lack of depreciation reserve fund implies lack of replacement investment. So, what will happen in the economy? The gross investment would tend to fall. This leads to the fall in the level of output because of the depreciation, and the level of income and employment will also fall. When this falls, it takes over to economic slowdown and it might be caught into a low level of equilibrium trap. So, depreciation reserve fund has a very important role to play. How do we calculate this depreciation? Say, suppose the cost of a machine is equal to 10 lakh rupees and the lifetime of the machine is given as 10 years. Then depreciation reserve fund per year that the firm needs to keep aside would be the cost of the machine divided by its lifetime. So, that gives us 1 lakh per year. So, the firm must make sure to keep this 1 lakh aside every year in order to take care of the depreciation. Now, there is something called unexpected obsolescence or capital loss. This unexpected obsolescence is due to natural calamities like for floods, earthquakes, etc., or due to a fall in the market value during recession. And this unexpected obsolescence or the capital loss is not a part of depreciation reserve fund. Is not a part of depreciation because this is unexpected. This is expected because the machines undergo wear and tear. And we know that after a period of time, the value of the asset is going to reduce. Hence, the depreciation reserve fund.